Why would I want to own, like here, I always say this, I want to own notes relative to single family residences, but I don't have a problem owning assets that is commercial or multifamily or something like that, just because of the nature of the two types of assets. But to your point, so I started seller financing a long time ago. I had a property. I came out of the crash. I did everything wrong before. There wasn't education. There wasn't Zoom and Facebook Live and stuff like we're doing right now on YouTube to really educate people on how to prevent from making mistakes. That's why I'm so animate about doing things like this to help educate, because it's really the key to understanding what you can do, but also what you don't want to do. And I made a lot of mistakes. I didn't have REI closed back then, didn't have education and like we have it today. And I had a property and I bought it, or I didn't buy it. They mailed to a list. I got a property that came in, and this was a long time ago, and it was a cheap property. I mean, super cheap. And the lady goes, I want to sell it. She goes, but there's a tenant in there, so please don't go disturb the tenants. I'm retiring from General Motors. I'm moving to Florida to be with near my grandkids. And I said, fine. So I drove by the house and I go, oh, that's what a $25,000 house looks like. Remember, this is a long time ago, right? You can't, this point at a, 25,000, is $100,000 house. It was a little 2-bedroom, 1-bath POS, 700 square foot house. And that's what you would see today. And this was in Dallas. It was what you'd see today at maybe $80,000, right? If you can even find an $80,000 house now. And so I was driving down the street and I saw a sign that said Vende Casa. I know Spanish to be dangerous. So I called him, I go, hey, I see you have a house for sale. Do you know anybody that might be interested in buying it? And so forth. So we went down that path, and, long story short is that we, found out that there was a lot of people out there that needed financing that could not go down to a bank and get a traditional bank loan. And now it's even more prevalent today than ever, because here's another, fast fact or whatever you want to call it. Talk about the $30 billion market. Yeah. But you know what else there is? About 60 to 70% of the population can't even go down and qualify for a bank loan.
Right.
Okay. So when you think about this, and this is what sort of drives me a little bananas, to be quite honest with you. If up to 65 to 70% of the market can't go down to Chase, Bank of America and get a bank loan, okay, and less than 5% of all properties available for sale are available through creative financing, you think that you'd have them lined up 100 deep to be able to get into that house, because you can provide them the ability to have home ownership when banks have told them no. So it really sort of baffles me when I see this poorly written paper and poorly underwritten buyers, because there's really no need for it. There's more demand for owner financing than there is for retail right now. And that's not going to change. The other thing I want to say about that is that people always there was always a negative connotation relative to seller financing for a long period of time. They thought it was stuff that a bank wouldn't lend on, for example.
Yes, exactly.
Or they thought that it was a bad buyer, but the numbers say otherwise. I mean, I think the average now for owner financing is like over $200,000.
Amazing.
Amazing. So, but to your point, when we can get into this in here, the deal structuring is where the value comes in. Okay. People say that you make your money when you buy the asset. Well, that might be true in a traditional real estate model. Right. But in the note side, it's not that at all. It's how you structured the note, how you stack the collateral file. Did you do a contract for deed versus a mortgage or deed of trust? Yeah. Okay. Is it in a judicial or non-judicial state? Are you servicing it? Yes. Did you use RMLO? All these little things are the important characteristics that add up to a premium note that like banks do. And I always say it, and then I'll let you guys continue on, is that what would a bank do? Correct. That's the first thing I asked the question. What would a bank do? Okay. Mm-hmm. Would a bank do a contract for deed? No. Why would you need? People could do contract for deeds all the time. And I'm not saying there's anything wrong with the contract for deed. Yep. I'm just saying banks don't do contract for deeds. Right. And why is that? Because they don't need to.
And they don't want to own
They're
property.
perfectly protected if they write the promissory note and everything correctly. They don't
Yeah.
need, and if they underwrite the buyer correctly, they don't have to, they have a good borrower, right? I mean, seller financing does not equal bad borrowers, okay?
Right.
It just
Right.
doesn't. It just means that they might not check all of the boxes that a traditional lender needs. Their DTI might be a little bit off, or they may have only been in.
That's debt to income, by the way, for those who don't know. DTI is debt to income.
Yeah, sorry. Their credit score might be not up to the minimum. There's another fun fact. Okay, haven't seen the latest numbers.
Yeah.
But up until when I checked it the last, the average declined credit score was 708.
Wow.
Declined.
Wow.
The average. I mean, are you kidding me?
Yeah, that's
I mean, 708 is a good credit score.
yeah.
I mean, I'm just telling you, my credit score is not 708, but I manage credit. I use it. I leverage it.
Yeah.
It goes up 50 points, down 25, up 75. But that's just the way I use it to my advantage. So I can never go down and get a traditional bank loan. And I'm fine with that because I don't need to. I can do what we're talking
I
about.
think a lot of people, when they create these notes, they think from the borrower's point of view, and they try I need to get a borrow in place, and I write notes, originate, but they don't realize the other side of the space of, if things don't go right, how are you in a spot where you're not going to have a problem, right? If your borrower defaults, are you going to have a heartache going to foreclosure because maybe you originate too many loans for the year, or you didn't hire a licensed originator?
Yeah.
Maybe you didn't underwrite it at all because you did a land contract, not realizing that you need to underwrite land contracts if the borrower is still in the home. So when you use these kind of things, now underwriter, granted, if you're experienced, you can underwrite yourself. However, we do have Max, call underwriter, in the back end here, off camera, but you have to understand that when you originate these loans, everyone does this kind of stuff. But if you don't do it correctly, that's the first step for a note buyer to say, I'm out.
Well, look, and to that point, and they might not say they're out, but it's going to cost you in the discount,
Yes.
right? And here's what people don't understand. When you give up that discount, you never get it back.
Yeah.
It's gone forever. And if you understand amortization, you look at the effect of that discount inside of an amortization table, it's a hell of a lot more money than the hard number that's on top of it.
Yeah.
So one of the things that we do, and what I do, and what I didn't do in the beginning, is now we write first and second lien mortgages. Okay. And the reason why we do it is to what we're saying, because we're thinking of it from the note buyer's perspective. And what are the main things that a note buyer is looking for when they analyze a note to buy, right? So
you mentioned discount. For those who may not know what that means. So discount is there's a balance of the loan, either at origination or current balance, and we're going to pay less for that. I give the example like a lottery, right? When a lottery is $1 billion, you don't get $1 billion, you get $500 million, right? So you're going to get a discount based on the unpaid balance because of the fact that you're getting money now versus later. So the discount off of what the balance.
So you have time value money. That's one, but there's other things too, right? There's how there's the
interest rate. We're gonna get into all that, but we want to start first off, originate good paper, solid paper, right? Writing a piece of paper on a napkin, writing on a napkin what the terms are for a borrower doesn't always equate to a good, solid, sellable note. Not saying if you never sell it, it's not good, but if you default or you want to sell it, it's not clean paper.
I would say that is probably the number one. So this is probably the number one thing that I see across the board more than anything, is that when people go and they want to create seller financing, okay, and they go to a title company, most of them still use a title company. Some do not. They do whatever. But what happens, they have somebody prepare their documents, okay, their lender documents on their behalf, okay? And, Maxim probably talked a little bit about this too, but what most do, they prepare the lender documents from a legal perspective,
right?
Okay. So they can file it, they can record it, they can do everything from a legal thing. But let me tell you something. I could give two rips about the legal side of it if it doesn't meet the lender side of it, right? Because there's certain things that we need to have that they're written, like how is servicing addressed in your promissory notes? Okay.
Yeah.
Servicing is a lender, a title that you hire from a title company, an attorney that crafts it. Are they even going to ask you about servicing unless you tell them about it? Right?
Mhm.
Probably not, because it's not a legal requirement. Right? Well, let me tell you
You
something.
can service yourself, but those who
Good.
are getting into notes or want it, I recommend getting with a servicer because
100%.
if you do things wrong, you violate federal law.
Well, that's a whole nother issue of itself. But if you, for example, you say, I'll just self-service it, great. So that's fine. Well, that affects the yield when you go to buy, right? So that's a huge discount that you're going to have to eat at some point in time if you decide to sell and liquidate. But here's the other thing I see a lot of times when people do it, they'll go in and they'll put in the dollar amount of the servicing. For example, $20, $25, $34, whatever it is. Okay. Well, let me ask you a question. Do you think 10 years from now, servicing is going to be $20 a file?
No.
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 Do you
Exactly.
think 15 years it's going to be $30 a file? For all we know, with inflation, it could be $100 damn dollars a month, maybe 200. We don't know, but guess what's not going to ever change? The borrower's payment. The borrower's payment will never change until it's paid in full. Right? The principal, the amount of money that goes to principal versus interest, that will change, but the dollar amount will not change. Really, really critical to make sure that you're writing promissory notes, even for your own benefit, even if you don't say you want to sell, you got to write them the right thing. That's why we have the transaction management company to do all this stuff. So people don't, it's like gun safety. Okay. I can give you a loaded gun. Okay. But if I don't teach you how to use it properly, you're going to maybe hurt yourself or somebody else. And I don't want to be responsible for that. Right. So nobody does. So you got to really understand it. And just because an attorney does the doc prep doesn't mean they're doing it for the things that we need to have in place. Super important, super critical, because that's going to have a tremendous impact on the value of the note when you go to sell it.
Yeah, absolutely.
Nathan, I know one thing we ran into recently is the servicing question.
Yeah.
For those people originating notes,